Hey everyone, welcome back for another edition of Your Money Matters. I'm Angela Giroux, publisher of the Bauman Letter, and I'm with Ted Bauman, our editor, and Clint Lee, our research analyst. Again, there is a link below to find out more about the Bauman Letter. If you're curious, you want to see what it's all about. Also, as a reminder, Ted posted a great video last week that explains more in detail what we do here. So I highly recommend you check that out after this video. For today, of course, we're going to be turning to the markets. There's been volatility once again. We see markets rally on great news of vaccines, and we've had some tremendous news. It's very exciting. And then you see it sort of pull back, come back to earth. This political uncertainty just will not end. The election is over, but the fight is not. So we have all this turmoil, plus you throw in the rising COVID numbers. It's a little bit of a mess. The good news is, of course, that we are almost to the end of 2020. I know
nobody's going to miss, okay? Nobody's going to miss this year. So
6 more weeks, just hang on a little bit more. But to get you through those 6 weeks, we're going to take a look at what we might be able to expect, what sort of challenges we'll face, what sort of opportunities we can find in the market, and maybe some defensive moves as well. What do you think, Clint?
Yeah, well, let's just talk about the direction of the market first. I
Sure.
mean, you brought up the volatility and the headlines. Look, I have never found success trying to invest based on what today's headline is versus what it was yesterday. And this year in particular, and right now in particular, there's such a dispersion of good news and bad news with the vaccine versus the rising case numbers. So when it comes down to it, I like to try to tune out that noise by focusing just on the market internals and try to see what those are telling me. And right now, that's painting a pretty nice picture going into year end. That's for a couple reasons. One is that we've seen participation in the stocks up moves just absolutely come roaring back, because that was a big issue earlier in the year, right? We talked about the FANG stocks or the stay-at-home stocks driving the bulk of the gains. Well, that hasn't been the case the last couple of weeks, and I'll show you a chart to illustrate a point here. One of the things I watch is just with the daily performance of the market, what the number of advancers versus decliners look like. And this is that chart of that ratio in this shaded grayish area over the last couple of months, overlaid with the S&P 500 index. And usually if you have a decent update on the market, you tend to see a ratio of about 2 to 1 on this ratio. But if you look at the right-hand side as a scale, you can see that we had several days where we were over 5 to 1 and 6 to 1, once again, over multiple days, just in the last several weeks. And that was evidenced by, small caps came rolling back. I mean, small caps are now up on the year. And so that participation, that's a good signal for markets, at least just over the near term. And the other thing is seasonality as well. We're just now entering what's historically been a very seasonable time frame for the markets, even as we go into next year. But just looking through year end, here's a chart that LPL put together, looking at how the market tends to do, going back to 1950 during election years when the president was up for re-election. And you can see what the yellow highlighted area, that was sort of that choppiness that we did see going into the election. But when you start to look in November and December, we've been following this pattern pretty closely, where we had the surge in performance following the election and with the vaccine news. Now, if you're going just based on this, you would expect to see us maybe consolidate those gains a little bit here over the next week or two. I wouldn't be surprised by that, just given the run in the markets that we've had recently. But you can see then back half of December, you start to see nice gains come in once again. So I wouldn't expect any.
Are you going to put money on this happening this particular election year?
It is 2020.
Because history's all good, but we're in uncharted waters there, Brew.
We are, but once again, I mean, my opinion, I think if you can take it down to just looking at what's occurring within the market and tuning out some of the noise, that this is telling me that things look good. But I think you do need to be selective going into the final month of the year.
Tell us about that.
Yeah, and that's because of just the prospect for tax loss harvesting in particular. If you're a taxable investor, you should be looking at this as well. If you've been able to ride the momentum trade, the stay-at-home trade, and you've had profits there, you should be looking for opportunities to harvest some losses in other positions to offset those profits. It's just a smart tax move going into year end. But the reason I bring that up is because of the potential for that to happen this year. So I wouldn't be looking at sort of the beaten up sectors to keep staging this rebound into year end. I would gravitate back toward sort of that momentum or that stay at home trade. Now I'll just show one chart here to illustrate the point that I'm making. This looks at the performance of the underlying stocks in the S&P 500 year to date, sorted from best to worst. So while the S&P is up just a little bit over 10% this year, half of all the members of the S&P are actually down. And so you can see, I mean, you see this incredible dispersion of returns. And that's why I say this year in particular, as we go into year end, there's lots of opportunity for loss harvesting in those sectors that were beaten up this year. So that's just something to be aware of as you position for the final month here.
Can I just jump in on that, because I'm looking at this chart and it goes to something that I'm going to talk about in a minute, but just in terms of where you might want to harvest specific losses, I would definitely take losses in financials right now, based on what I'm thinking is going to happen next year. If you're down on any financial stocks, banks, I would sell them now and just wait to see what happens in the financial sector, because I think things are going to get worse before they get better. The other one is I wouldn't necessarily sell real estate, because I think it's going to bounce back strongly. I think a lot of people have noticed that the REIT sector, for example, has started to bounce back in anticipation of the vaccine. Certainly energy. I mean, I don't think that's going to come back anytime soon. So just be selective, I think, is what I would say. But financials, no-go area for me.
And Ted, you said you think things are going to get worse before they get better. Do you want to touch on that a little bit?
Sure. So basically, I want to show you a couple of charts here that my line of thinking was prompted by the news that Treasury Secretary Mnuchin has said that he wants the money back from the Fed that was given to the Fed in order to provide a backstop for the corporate debt markets. They also withdrew they want to withdraw some other facilities that have not been used. But remember, the corporate debt backstop doesn't need to be used to be effective, and it has been tremendously effective just because it exists. My concern is what happens if it ceases to exist. So let's first start with the yields on income generation or basically high yield and liquidity bonds over the course of this year. Now you can see that they were tracking along more or less normally as they normally do, and then they took a big dive in March. But then at the end of March, when the Fed announced this facility, look what happened. I'm going to come back to this in a minute, but you can see that the Fed's simply announcing the facility was a big deal, and that led to a very rapid bounce back in the bond markets, and particularly for high yield. So the next chart shows the basically the adjusted spread between basically high yield bonds and the federal bond rate, and as you can see, it rocketed at the beginning of the year, and then it's come down basically back to normal territory. And that's all thanks to just having this facility in existence without them having to actually use the money in it, right? Now, let's look at what the bond market did in response. Well, the issuers, the companies that sell their debt, you can see they on a quarter by quarter basis, they have continued to, on an annual basis, 2020 is probably the biggest year since 2012, which was another time when the Fed was really helping out the bond market. They poured debt into the market because they know that the Fed has got their back. That's kept yields relatively low. They want to lock them in. And a lot of companies that only earn enough money just to roll over to their next loan, they've issued new debt to do just that. Not investment, not creating new jobs, just rolling over existing debt. Next chart shows you the quarterly composition of this debt. And as you can see, the biggest chunk of it is refinancing of existing debt. So companies are saying, hey, we better grab the opportunity to roll over our debt because the Fed's got our back. Next chart shows the composition of the debt that's been issued. And you can see right there that the unsecured component, like the riskier debt that's not secured by assets or anything else, that's the biggest chunk. So fundamentally, what's been happening is that the existence of this facility has basically made the corporate bond market behave as though it were a normal year. The last chart I'm going to show you on this shows precisely that. The blue line shows the the yields on corporate, high yield bonds. It's actually an ETF that tracks them. They're not that different from what they are historically. They're kind of trading within a little bit of lower band, but they're not all that different. There's the S&P at the top, but then look at the 10-year Treasury yield. It's been rising. That's the falling line there. Basically, so essentially, as that gap between the Treasury yield, because it's starting to rise again, you can see it ticking up at the bottom right-hand corner. As that yield starts to rise again, that's going to put pressure on the spread. It's going to mean that corporate debt is going to be less attractive because potentially you could get safer returns in the bond market. Put all this together, you take away this thing. I think it's a ticking time bomb that the Trump administration is leaving for the Biden administration. I think this is something that people do not understand how important this is. As soon as a company goes into the bond market and cannot get a full subscription to a new issue, as soon as they can't roll over at current rates and have to go up by a percentage point or two, you're going to start looking at potential bankruptcies, and you're going to look at companies laying off employees, not just because of COVID, but because they have to trim expenses in order to be able to afford these higher interest rates. And if that's coming, this is something that I think the stock market needs to factor in. And that's why I said stay away from financials, because if you get those ripple effects, they're going to come up first there. So that's my negative perspective. I think you really need to pay attention to this. I don't think that the stock market is yet priced it in. On the positive side,
I was just going to ask, where's the opportunity?
All right, here's the opportunity. I like Chinese electrical vehicle manufacturers, and I'll tell you why. Essentially, I think people are going to recognize very quickly that the U.S. market is troubled. We saw an uptick in new unemployment applications. We know that COVID is literally out of control. Like I said, there's a time bomb in the corporate debt market. So as we've predicted, Clint and I think people are going to look for money out of the United States. So where are they going to look? Well, Europe's also got problems. The one place in the world where things are not going so badly is China, and the growthiest of all growth sectors in the Chinese economy is electric vehicles. They really like them. The government really likes them. They're putting everything they have behind them. Here's a chart that shows the performance over the last 3 months of one stock most people probably know about, a company called NIO. It's had a tremendous growth this year. I mean, it's just absolutely blown. It's like 1,000% or something. But here are two new ones. There's two other companies that have come up, and as you can see, since the beginning of this month, they've just taken off like a rocket. And my thesis is that they've done that because people are looking for opportunity, and they're looking for opportunity that actually has some rationale behind it. These companies both have very rapidly growing volumes. They have growing revenue. They're still not making money, but they're going to make money eventually. So in the short term, I think if you want to make some money, I would take a flyer on these Chinese electric vehicle companies. I think they are actually, in the short term, going to even continue to provide big growth, even though they already have, simply because people are looking for opportunity. So that's my bet for the end of the year.
All right, well, that sounds good. And speaking of China, that leads us to the Bauman letter, because we just released our December issue, and perhaps some investors are not comfortable putting their money in China right now. No problem, because Ted has a China play that is not based in China, it's based in Europe. So you're playing on all these sort of growth trends in China, but your money is safely tucked away in European stocks. So if you'd like more information about that pick, again, please join the Bauman letter. The link is below. Ted, Clint, thank you so much.
One last point, that stock is up by double digits in about a week.
Love that.
So it's doing really well.
Thank you, everyone.
All right, have a good week.
Bye-bye.